Today on Think Smart with TMFG, Mike and I are going to be reviewing 20 reasons why you keep screwing up your portfolio.
It's actually part 2. Last time we did 1 to 10. Now we're taking on 11 to 20, right?
We are. So let's start with number 1, not knowing your performance. So performance is an interesting thing when we're looking at rates of return. And I think there's a couple of things that you need to take into account. To me, when you're comparing performance of different investments, you really need to be comparing apples to apples. If you're comparing a year-end return December 31st with a November 30th 12-month return, those are very different numbers.
Well, the other thing happens too is there's something we call start date bias. And start date bias really throws things off because your return is just as much based on when you started as today's dates, what happened. And we found the industry has tried to do a lot to they've got better over the last few years. On December 31st, everyone gets a report on their accounts that gives them an idea on returns. Other than the December 31st statement, though, they're not very consistent or accurate, are they?
No, they're not. And even that one is confusing for most investors. We're required by law in the province of Ontario and the rest of Canada to report what's called a money-weighted return. So it's based on when your money went into your account into those investments.
And the cash flows around that.
And the cash flows.
And when it came out.
And it also needs to be after fees. So after all fees have been deducted. So when you're comparing your results versus, say, the S&P 500, you need to make sure, number one, you're comparing the same dates. You're comparing after fees if there's fees. And you're looking at the exact same date.
Yeah, there's actually something called time-weighted rates of return, and that's actually much more accurate when you want to do an apples-to-apples comparison because it's not including the cash flows when you put the money in. So remember, it's not the investment's fault when you gave them the money. They have no impact on that. So under the money-weighted return, two of the exact same investments could have very different returns depending on when you put the money in. Under time-weighted, it's regardless of the money, it's how the investment actually did.
So one of the things I think of when I think of that is we know historically, we've seen all the charts, investors invest more money when the markets are up.
Yep.
So that's going to impact your money-weighted rate of return because you're putting bigger sums of money into your account when the returns are already up. The investment may be doing very well, but your timing of putting money in may not work out very well. So that's number 11. Number 12.
It's almost like money-weighted returns are discounted time-weighted returns based on people's mistakes.
Yeah. So it might be helpful to have both.
Yep.
Do a comparison. Is your timing bad of when you're putting your money into the accounts? Number 12, reacting to the media. I think this is probably the hardest. Not only is the media coming at you every day, whether it's radio, television, social media, but remember, today's media is customized to you. So if you like listening to all bad things about Donald Trump, that's all you're going to get. You're not going to get the good things about Donald Trump. I don't know if there are any, but I'm sure there's some. So what is that? If you're looking at, if you're interested in bear markets or market corrections, all you're going to get is information talking about market correction. You're going to be pretty certain that the market is going to correct because of all the news that you're reading on your social media apps.
And even beyond that, there's much more negative media than positive media. It's just negative news sells better. So if you want to get someone to read your article and stick around to watch the commercial, your best thing is put out a negative article.
So let's look at the data. 73% of the time, the stock market has positive returns.
Yeah.
But 1 out of 4. And that's been consistent all the way back to 1920. That's almost 100 years worth of data.
And 90% of the media news is negative. So it doesn't
90% of the world is negative. We're talking there's always a recession coming. There's always a market correction coming. And yet we know 75% of the time the market goes up. Number 13, not factoring in inflation. So I had an interesting experience the other day. I was reviewing a client's pension statement. They have been retired for 15 years.
Yep.
And we were looking at his pension statement. It's the Government of Canada pension. And his pension income was up 38% since he started in the pension plan.
Yeah.
That's huge. In other words, his pension pay has gone up by 38%. I bet most investors haven't necessarily kept up with that in terms of their investment portfolio. But that's the cost of goods. That's what inflation is. So when you look at your returns, if you're happy with a 4% return and inflation's 2.5%, you're only earning 1.5%, and that's before tax. You need to take it into account.
Problem is we got spoiled for a few decades, right, where we had very low inflation, sub 2% inflation. Now we're into a more realistic level, which has been the more norm for the past. We'd always look at those diagrams. You look at the past 50 and 80 years, it was somewhere around the 3% range. But everyone kept on saying it was too high for a period of time because we're 1.5%. All of a sudden, it's really just normalized itself to back where it's been over the last 100 years.
It's a little bit below. I think it's at 2.5 right now, the 10-year inflation number.
Yeah.
But that's come up from where it was at 1% 3 or 4 years ago over the last 10 years. So it's come up dramatically just because we had that period of really high inflation. Next up, number 14, trying to time the market. Mike, talk about that.
Everyone thinks they can do it. Even at times I've thought I could do it. You realize pretty quickly there's two right decisions you have to make to time the market. The first one's the obvious one, which is very easy. Okay, we're in a really high market. It might be time to take my wins and get out of the game. But the problem is once you've done that, then you have to make a decision to get back into the market. So even if you time the first one correctly, now you have to make the hard decisions to get back in the market when the market's much worse than it is now. And I found very few, if any, people have been able to consistently make that time and decision. We had one client we always talk about. He timed it perfectly right before the 2007 subprime crisis, got all his money out. It was 10 to 12 years before he's never been reinvested since.
It's been in cash the whole time at really low rates.
His returns are much lower than anyone else's.
I was listening to a Morgan Housel podcast recently, and he talked about something that I thought was really interesting. He talked about volatility and what happens with, let's call it bull markets. And he said bull markets and bear markets actually typically go beyond where you think they're going to go.
Yeah.
If we think the market's too high now, it may go up another 20% before the market realizes it actually went too far and it's probably worth only 20% less. The same thing happens on a correction. When things start going down, suddenly you realize, how did all the values of the companies in the world go down by 40%? But it had to go too far to figure where the boundary was.
Yeah.
The boundary's probably, maybe it should have only been down 25%. So everything's always going beyond their boundaries to help figure out what the boundaries are.
We always remember how bad markets can be. Sometimes we forget how good they can be. We do this thing called a lifeboat drill, and you go through it with clients too. The one in the 70s to 80s always blows me away, right? Because you watch someone at $2 million, it would drop to $1.2 million, and 5 years later be worth $4 million, and 10 years later worth like $10 million. It's something totally out of what you could think could happen on the stock market. But when the stock market goes in those bull runs, it can go a long way, and sometimes too long.
So boundaries, I think it might be interesting. Mike, do you have a boundary in terms of alcohol?
I think so.
Okay. But you probably only learned your boundary once you went past it a few times. You said, okay, you know what? I didn't like where I ended up when I had those 3 extra drinks. So think of boundaries. That's why the market is so volatile. Next up, not doing your homework, not doing your due diligence. If you just go and look, and here's a mutual fund that launched 4 years ago and has averaged 14% a year, and you go and throw $100,000 in it, that's not due diligence. It may be that they just hit the right investment at the right time. That fund company may have launched 5 different funds at the exact same time, and it's the only one with good returns. Maybe they've shut the other 3 of the other 4 down.
You have to drill down and always find out why. Whenever something happens, there's a reason. If something outperforms the market by any, let's say, reasonable amount, there has to be something they did very different than the marketplace, and they had to take a risk somewhere along the way. So the first thing you need is drill down and find out where that risk was. Was it going to one specific sector? Was it going to a big size factor, very small cap or micro cap in that stage? You have to find out what factor gave that extra performance. Then you sort of understand, and you've done your due diligence on that investment, you understand why it outperformed, and you take a good guess to see if that's going to continue.
I think it's interesting when you look at things. I'm reviewing my meetings for the week, and I see I have a client that's been with me for 20 plus years, and her 10-year return isn't very good. And I wanted to figure out why it wasn't very good. And as I looked closer, I remembered that all of the U.S. equity was hedged. That was her husband's wish when he was alive, that he didn't want any currency volatility. Well, the Canadian dollar is approaching, not quite yet, but all-time lows. We're certainly down around the bottom.
Yep.
And so that portfolio's missed out on all of the currency value dropping on all their U.S. holdings. So that's probably cost them 1% a year for the last 10 years.
Yep.
Now, do you make a change now? What if the dollar starts working its way back up to 80 cents or 85 cents? You're going to get it on the rebound. You're going to lose it on the rebound. If you stay hedged, you won't. So always make sure you're comparing apples to apples and you know why performance is what it is. Next up, number 16, working with the wrong advisor. Mike, how do you know you have the wrong advisor?
Number one, an advisor's job is not to always keep you happy. So it's not to go and say you're doing everything the right way. Sometimes an advisor's job is to go and set you straight, make sure your savings is okay. Your financial advisor should be focused on your financial plan. They shouldn't be focused on just investments. If you're sitting down with a financial advisor and all they talk about is how the investment did last month or last week or last year, you're probably with the wrong advisor.
Number 17, investing with emotions. It's easy to get excited about when you read in the paper that this investor doubled his money over 3 months, or he's got a TFSA worth $1 million. Why can't we all have a TFSA worth $1 million? You get so emotionally involved, or you get fearful. You make decisions because of who the president is or who the prime minister is and what their current policies are.
People are very confused with Tesla stock right now. It's been a funny one because it was all the environmentalists that went after Tesla at the beginning. Now all of a sudden Musk is involved in the government and they're all pulling out of Tesla.
Right.
So it's again, people making emotional investment decisions that shouldn't be based on emotions.
I have Starlink at my cottage. I guess I could move to a Canadian product, although I've tried them. They are inferior. So do I want to decrease my internet connection at the cottage?
Yeah.
It's a decision to make. Number 18, chasing yield. Mike, why do people chase yield? And what does that mean?
I don't know. It's funny. On the bottom of every investment, the first thing it says is, please note, past performance does not have any indication of future expected performance. I don't know. Maybe they should put that in big print on the front of everything rather than the small print, because no one seems to understand that. And everyone in the industry truly understands that more than anything.
I think let's use an example. Let's say, Mike, this investment pays an 8% dividend. What's your initial thought when you hear about the 8% dividend?
Well, people confuse dividend with interest. And they figure, well, my capital is going to stay in place and I'm going to receive 8% on an annual basis from that.
What's more likely to happen if they're paying an 8% dividend? There's a pretty good chance that there's a risk you're missing out on. Why are they paying out all that much money? Maybe it's because the stock is really undervalued. Maybe it's undervalued for a good reason. So you always have to be careful. What's most important is total return.
Yeah.
Total return is what pays the bills. Dividends aren't what pays the bills. A dividend is just a feature of a stock. It's just a feature.
It's moving from one pocket to the other. There's no money being made on dividends, just being paid out. And you've seen that with like BC over the last year or so, paying a great dividend, but the stock keeps on dropping like a rock over the last year. So it wasn't that you bought a stock with a 10, 12% dividend, but you're not better off than you were 6 months ago. Number
19, neglecting to start. And I guess this is a message to the next generation, those in their 20 up to age 40. You got to start, and you got to start even small. Get some money invested, gain some experience, Have it come off your pay every month, dollar cost average into investments. It is the simplest way. And if you stick to it, if you're dedicated and loyal to your personal savings, you will build wealth.
Earlier you start, the easier it is.
If you wait and try and hit home runs when you're in your 50s, that's a recipe for disaster. Finally, number 20, not controlling what you can control. Mike, can you control the market?
No.
Can you control what investors think about the market?
No.
So what can you control?
I can control the investments I do.
Okay.
And then I continually put money away. I save money. I can control my spending. And I can control the decisions I make. Not make any rash decisions and not decide to move into cash anytime and stay invested. Those are the things I can actually control. I control to a point the amount of taxes I pay. I'm going to have to pay taxes, but I don't have to pay more than expected. I can control how my portfolio is situated. I can control having my insurance in place if anything happened to me. I can control having a will, power of attorney in place. Those are things I actually have control over.
So we've covered 20 areas why you keep screwing up your portfolio. And I see these ads on TV, how simple wealth is. And, Quest Trade, do all the trading yourself, low cost margin, borrowing to invest, all of those things. And I think if it's that easy to screw up your portfolio, why are you trying to do it yourself? Mike, you and I have been at this business for a long time. We've made all of those mistakes that new investors are about to make on their own account for the first time.
Yep.
That brings us to the end of another week. Thank you for joining us. This is Rob and Mike with Think Smart from the McClelland Financial Group of Assante Capital Management.